There's a moment that plays out quietly in the mind of almost every new investor, usually somewhere around their first six-figure milestone, when they look at the number in their account and assume the hardest part is behind them, that if this took several years, becoming a millionaire must simply mean doing it 9 more times over. That assumption feels reasonable. It also happens to be almost completely wrong, and the gap between what people expect and what actually happens next is wide enough that understanding it changes how patient or impatient someone needs to be with their own progress. My name is Marcus, and this channel breaks down the parts of investing that sound simple on the surface but behave very differently once you look at the actual math. And if you've ever felt discouraged looking at your own account balance and wondering whether you're doing something wrong, sticking around for this one might change how you think about that number entirely. So subscribing helps more people see this kind of explanation. Most people think reaching $100,000 means they're 10% of the way to becoming a millionaire, a clean, linear slice of the total goal. They're not. That first 100,000 is, almost without exception, the slowest, most contribution-heavy, least reward-heavy portion of the entire wealth-building timeline, and mistaking it for a proportional tenth of the journey is exactly what causes so many people to feel like they're falling behind when they're actually right on schedule. Picture someone contributing a modest, consistent amount each month into an investment account, earning a typical long-term market return. In the earliest years, almost every dollar in that account came directly from their own paycheck, because there simply isn't enough principal yet for compounding to meaningfully add on top of it. If someone saves for several years and finally crosses the $100,000 mark, the overwhelming majority of that balance is contributions, not growth. It can feel like learning an instrument where the first months are all repetition and mechanical effort, with almost nothing that sounds like music yet. That's discouraging by design, not because anything is going wrong, but because compounding needs a base to work from, and building that base is the least glamorous part of the entire process. Here's where this gets really interesting, because the math shifts noticeably as that base gets larger. Consider what happens by the time the same saver reaches $200,000. It didn't take nearly as long to go from 100 to 200,000 as it did to reach the first 100, even with identical monthly contributions, because now there's real principal generating real growth alongside those contributions. It starts to resemble pushing a boulder up a hill and finally feeling it crest the top and begin rolling on its own momentum. The saver put in a certain amount from their own paycheck, but growth contributed a meaningful and growing share of the increase, and that ratio keeps shifting favorably from here forward. By $400,000, the pattern becomes even more pronounced. A large share of the increase from the previous milestone is now coming from growth rather than new contributions, meaning the account is, in a very real sense, starting to do a substantial portion of the work on its own. This isn't about depriving yourself along the way either, because the strategy that gets someone here isn't extreme restriction, it's ordinary, boring consistency applied over enough time for the math to start compounding in their favor. This is precisely why the $100,000 mark functions as a trap rather than a simple milestone. Someone who mentally divides their goal into 10 equal chunks of $100,000 each will consistently misjudge their own pace, feeling like each chunk should take the same amount of time as the last, when in reality the early chunks take dramatically longer and the later chunks accelerate. That mismatch between expectation and reality is often what causes people to abandon a perfectly sound long-term plan right around the point where it was about to start working in their favor. Someone might reasonably point out that markets don't move in a straight line and that crashes or downturns could disrupt this entire picture. That's a fair concern, and it's true that growth isn't linear year to year, but over a long enough timeline, temporary downturns tend to function less like derailments and more like discounted opportunities to add more shares at a lower price, which is part of why consistency through volatility, rather than trying to perfectly time it, is what allows the compounding described here to eventually take hold. So the $100,000 trap isn't a flaw in the math, it's a flaw in how our brains expect progress to feel, linear and evenly paced, when the actual mechanics of compounding are anything but. Recognizing that the first slice of any long-term goal is disproportionately the hardest doesn't make it move any faster, but it does mean that anyone stuck in that early, unglamorous stretch is very likely closer to an inflection point than the discouraging feeling in front of them suggests, and whether that shift is visible this year or several years from now, the underlying mechanics don't change. Only the moment someone decides to stay the course does.